Hey Susie, so today we're going to be talking about your finances and credit in your life. First, let's establish your goals. You have your short-term goals, which are goals that you can achieve in a year, and your long-term goals, which you can achieve in 5+ years. Next, let's talk about your financial organization and planning. Those include a balance sheet and a cash flow statement. A balance sheet describes your financial condition through assets, liabilities, and net worth, while your cash flow statement lists and summarizes your income and expenses. Your financial condition consists of asset-to-debt ratio and investment asset-to-debt ratio. The asset-to-debt ratio answers the question of, do I have enough assets to meet my debt payment? While the investment asset-to-debt ratio answers the question, am I investing enough money? Credit is really important in achieving your financial goals and improving your future net worth. With good credit, you'll be able to obtain car loans for your future new car or even mortgage loans. Good credit status shows that your financial situation is on the right track. Credit cards contain several features such as APR, grace period, and fees. APR stands for the annual percentage rate. It's the interest rate paid for purchases. There's two types of APRs, fixed rate and variable rate. Fixed rate APR means that APR remains the same within the time period defined in the credit card agreement, whereas a variable rate APR changes based on the economic conditions. Grace period is a time period between the posting date of a transaction and the due date. During this time, there's normally no interest is accumulated. Fees, on the other hand, there's two types, annual fees and penalty fees. Annual fees are charged for having the credit card. It's kind of like a maintenance fee. And penalty fees, there's late payment and over-the-limit fees. Credit reports contain information compiled by a credit bureau from merchants, utility company, banks, court records, and creditors about your payment history and credit score. A credit score is a statistical measure used to rate applicants based on factors deemed relevant to creditworthiness and the likelihood of repayment. A high credit score normally means is good, while a low credit score is bad. FACTA stands for the Fair and Accurate Credit Transition Act. With this act, you can obtain a free credit report every 12 months from national credit bureaus such as Experian, Equifax, and TransUnion. It also provides arrangements to help reduce identity theft. Basically, when receiving your credit report, you should review it carefully for any misleading information or errors. If errors are found, matters should be taken immediately through FACTA. Identity theft normally occurs when someone takes your personal information, credit, or account and uses it for their own benefit without your knowledge. With a stolen identity, the thief can apply for a new driver's license, credit cards, rent an apartment, and more. If you suspect someone has stolen your identity, you should follow these steps. Number 1, close all credit cards and bank accounts immediately. 2, place fraud reports with the credit bureaus. Next, file a police report, but most importantly, file a complaint with the FTC. After an identity theft, you should be more careful managing your financial records, be more cautious as to where you place your information, and make sure you review your credit report at least once a year. There's a lot that goes into financial planning and organization, and I hope with this PowerPoint, Susie, that you're ready to conquer it.